G'day folks, thanks to one of you wonderful investors suggesting in the comment section that I roll back the clock to 2019 when my portfolio was only worth $100,000 and do a consecutive year-over-year look to see how much my portfolio has changed coming into 2023 where it's almost worth $400,000. And I thought that was a really fun idea, but I also want to break down for you why I think this is the year we are going to become millionaires. This recessionary environment is opening up a huge window of opportunity that has led me to invest over $20,000 just in the first week of January, the first week of 2023 into Taiwan Semiconductors. And I want to explain to you how I came to that conclusion first, because the fact is, guys, is when we head into this recessionary environment, we have to understand why this is happening. And a lot of it has to do with the interest raised environment. This constraints consumer spending, whether you're trying to get a mortgage, an auto loan, big companies with a lot of debt that are trying to do acquisitions. All of this affects their earnings per share, especially obviously when consumers are spending less. This leads to analysts revising future expected cash flows out of all these large cap companies, which drive down the PE ratios, drive down the stock price. But what you have to imagine is that at some point we are going to be on the other side of this recession, and the companies with true moats, companies that are the backbone of society, will then again start to pick back up. And as those companies pick back up, analysts are going to revise the future expected cash flows. And then all of a sudden, guys, we're going to see PE multiples start to go back up. We're going to see stock prices start to go back up. When that is, I don't really know, but that's why we're in a window of opportunity right now. And I want to break down how I came to the conclusion that in this window of opportunity that I thought it was most prudent for me, not financial advice, but to take a really big bet on Taiwan Semiconductors. Now, the beginning of the year has been incredibly tumultuous. I mean, the S&P, the NASDAQ, Tesla stock, all over the place, the volatility index going nuts here. But I'm going to be using this new tool that my trading platform offers to give you a view of the underlying earnings per share and the actual stock price as those earnings have changed over time. Firstly, taking a look at Apple stock, guys, which peaked in 2021, that is now down roughly 30% from its all-time high. Apple is a bit of a cyclical based company because obviously during the holiday seasons, people might be more inclined to purchase iPhones and Macs, and Apple's been trying to stabilize these earnings by obviously getting into streaming and more basically monthly subscription-based revenue. But we can see, guys, that yeah, things have cooled down a little bit here, and we're going to start seeing the window of opportunity in some of these other stocks because Apple is a large company in the world. The PE comes down enough. I think it's a huge buying opportunity, but even in this market, I still think it's kind of expensive, but that's left up to interpretation. Whereas Microsoft has a really stabilized earnings per share growth based off mostly switching to a subscription-based model. We see this with Adobe, a lot of these kind of high-flying tech companies. And even though the earnings have stabilized with Microsoft, they're not growing. So you can't be paying a 20 or 30 multiple for stock where the earnings per share are just basically flatlining. Even though this shows true resiliency heading into a recessionary environment, you kind of got to start respecting that this is going to be inevitably a buying opportunity of a lifetime. And where we can see the impact for sure is with companies that do marketing like Google, whether you're buying Google ads, YouTube ads. A lot of people, as they constraint up on spending, the first thing they cut is marketing expense. And we see that in the bottom line in the earnings per share growth that was coming out of Google through 2021, but now into 2022, leading into 2023, we're really starting to see the stock price get super suppressed. We're seeing the PE come back down to a reasonable rate, and that's all because of the future expected cash flow based off the EPS decline. However, when you're looking at companies like Facebook, it's really hard to wrap your head around because not only is this company investing those earnings per shares into future expected technology like VR, but they're also seeing a decline in marketing and ad spend, right? And the problem with that is it puts a lot of risk into the company, which is why we saw Facebook take the biggest single day drop in 2021 out of any S&P 500 company. But again, that could be opening up a window for a huge rate of return because the stock price is super suppressed. The multiples come down incredibly. And if you believe VR is the future, then at least this company has the earnings per share and the income to back that even in a recessionary environment, right? But when you're taking a look at companies like Amazon, for example, this is a stock that I've never been able to touch. I have exposure through my indexes, but you just don't understand where the company's future earnings are coming from. Yeah, they have explosive growth on e-commerce. They've never made money off that. Like they've never made bottom line cash flow. Most of their EPS primarily just comes from cloud-based services. But again, when you look at the EPS chart and the volatility in the stock, it's just so hard to wrap your head around what the future cash flow could be for a company like Amazon. And Tesla's kind of on the other edge of the spectrum because not only does Tesla have like the highest value of any S&P 500 company, it also had the highest growth of any S&P 500 company. And we can see that in this earnings per per share. But I don't need to get into Tesla, as a lot of people are fearful of their future EPS growth. Obviously, when you're buying a Tesla and most people are using debt, and now you're getting it at a 5-6+% interest rate that really declines, or makes people not want to buy those cars. There's just a lot of factors coming into play here that, again, could be setting up for a really good buying opportunity, but you're buying a lot of speculative growth and you're getting that volatility that comes with that. But that's what led me to the conclusion and why I think that Taiwan Semiconductors is the best stock for me. Again, not financial advice, but I dumped 20 grand into this company just within this first week here, guys, because not only is the stock price getting super suppressed, this company has seen really great EPS growth coming into this recessionary environment. They're making huge investments, the largest investments the US has ever seen into factories, and this company's globalizing. They're the backbone of society. Apple, Nvidia, Qualcomm, all these companies can't function without Taiwan Semiconductors. I'm going to do a video on the future on why I just think this is probably the best investment I can be making right now, because obviously this chart is a good exemplifier of one of those reasons. But nonetheless, guys, this is what you're going to want to pay attention to, and you're going to really need to start working hard and driving cash into these markets if you want to become a millionaire in the next 3 to 5 years, because this is your window of opportunity and you need to start capitalizing on it while there is crazy blood in the streets, while there's way too much fear, and when we know inevitably this recession is going to come to an end. I don't think we're on the other side of it yet, but when we do, it's going to be too late to start getting prices like we're seeing right now. So taking a look at my portfolio first and foremost in 2023, and we're going to backdate to each beginning of the year, going all the way back to 2019, guys. We can see the portfolio. I've got about 370,000 invested. I'm down to about 25,000 in cash. We can see the 5% of my entire portfolio investment that I made in Taiwan Semiconductors. I did a little bit of adjusting to kind of reweight SCHD and VOO. So that makes up about 50% of the entire portfolio. And then obviously my Canadian Dividend ETF here, VDY, making up about 37%. I might do a bit more adjusting, invest another $5,000 of this cash just to see my dividends get back over 11,000 annually. But this is kind of just where we're sitting into 2023. And obviously I think these ETFs are going to offer a lot of stability. And then I'm going to start really dipping my toes back into some of these individual investments. I do have an eyeball on Apple. If it drops enough, I wouldn't mind re-adding that as well. But nonetheless, let's step back in time here. And I'm sorry that this is going to be a little blurry. I had to take screenshots from videos from like years ago, but this was going into the beginning of 2022. So right at the end of 2021, guys. And it's really incredible to see how many individual stock positions I really owned. I did have a little bit of the S&P 500 index, which is crazy, making up 6% of the portfolio. Apple next in place here, guys. Then we had Microsoft, Facebook, Google, Tesla. We can see how heavy weighted I was in some of these individual tech stocks. And I think the best decision I made at that second quarter of 2022 was really selling off all these individual positions and weighting these ETFs, because it saved me a small fortune. I would be down tens of thousands of dollars right now if I kept all my weightings in these individual stocks. But we can see that these are pretty resilient companies. We had Johnson & Johnson, Pepsi, TELUS, Bank of Nova Scotia, Canadian Pure Bank, TD, Royal Bank, Stag Industrial, Granite Real Estate, Riocan, MPW, this medical property REIT. And we can see that the cost basis, go look at these and then go look at what the prices of these stocks are today, and you'll see why I got out at probably a really opportune time. Now, during the beginning of 2022, the portfolio was worth $375,000. So my portfolio hasn't really increased that much. We're sitting at about $395,000, even though I basically made 6 figures last year, putting a lot of it into these ETFs because the market's been back weighting. Most of the growth in my portfolio has just come from invested capital, from me actually working for a living. Now, stepping back into 2020, going into 2021, the portfolio was worth about $247,000. And you can see the weightings in these positions didn't change much, because a lot of people were calling me out for like pump and dumping, Facebook and that. But you can see I actually held Facebook, Apple, Microsoft. I held these stocks for years. But during this time, we can see I was a little bit more speculative in the market because I was holding MindMed. And at this time, MindMed was 15% of my entire portfolio. I had this Tesla position back at that time. I owned a lot of different dividend stocks like MO, British American Tobacco, some of these sin-based companies that I don't have an appeal for at all during this time. And also, this wasn't even that long ago, but I was holding GEO Group, that prison stock that Michael Burry loved so much, for a period of time. And obviously, I lost a lot of money in GEO Group, but we'll see that as we step back even a little bit farther in time. But first, if you guys enjoy these portfolio overviews, you want to understand your diversification a lot better and bring all your brokerage accounts into one place, support the channel by coming to portfoliospreadsheet.com. A link in the description below. Use coupon codes DIVIDENDS to get 30% off. The price will be going up once we finish the Excel version in the next month or two. We will be doing patches, but just purchasing one of these products, you'll get all of them for free. And we go to the period of 2019 into 2020. 2020, guys, this was where my portfolio was just worth over $100,000. 2019 was a rather different learning experience for me, but because this portfolio overview doesn't really show as much detail, because this was before my portfolio reviews became a lot more advanced, I had to take some screenshots of my accounts. And at this time, guys, if I zoom my head out a little bit here, we can see that I held a lot of those same companies that I talked about for years: Bank of Nova Scotia, Canadian Imperial Bank, Northland Power, Riocan, right? We had Altria Group, Apple, British American Tobacco. Look at my return on Apple back then. Apple at this time, I think this was pre-split. I mean, I bought the stock for like $172 a share. I think my average buy price after all the splits and everything was like not even $20 a share. I made a huge percentage gain on Apple stock. We can see I had British American Tobacco still in here, GEO Group, Microsoft, Southern Company. These are all pretty resilient companies, and you can see that nothing really changed over these long period of times with the investments that I made. I've been very methodical about how I've been buying stocks, and I might make like incremental changes, but nothing really major happened until coming into, last year, the first or second quarter of 2022, because that's when I made this pivotal decision that my portfolio got way too large for me to be investing a lot of capital into individual stocks. I just felt like I don't want to be that guy that has 50 different companies in a portfolio and not actually putting any due diligence into them as they change over time. If you're managing individual stocks, I think it's rather different than holding ETFs that passively weight them. And I was one of those people that truly believed you could just pick some of the S&P top 10 companies and hold on to them for a lifetime. But the fact of the matter is as the economy changes, different companies in different sectors will start to overtake some of these best performing top 10 companies. As we can see on this chart from 2000, if you thought you could just hold some of these companies for 10 or 20 years, you'll see some of these dramatically underperformed, and then stocks you didn't even know would be the largest companies in the world, like Apple, really started to take over within just a decade, right? So you kind of want to have exposure to all of that and take the best benefit. So that's why I made this decision. And a lot of these ETFs have been relatively recession proof. VDY has outperformed the S&P 500, SCHD has outperformed the S&P 500, and it's led to really stabilized performance and leading me to actually outperform all the biggest investors over the last 5 years, whether it's been Warren Buffett, Cathie Wood, and making some of those pivotal decisions to sell off those tech companies at really good times. But now I want to get back into the individual stock game, but the way I have to do it is very cautiously and not to overweight the portfolio. So what I'm trying to do right now is all my money is going to be going into Taiwan Semiconductors. I want to get this to be about, probably about 7 to 8% of the portfolio. And until I see something that is more attractive than that, which I'm pretty much just looking at Apple stock again, when Apple stock gets to what I think is a moderately good value for me, I'll probably start buying back into that. But I really don't want more than 2 or 3 individual stocks over 2023 in this portfolio, because I want to keep cost averaging indexes and make sure those are the stabilized aspect of the portfolio, and then make these decisions on these individual investments to continue to be the growth driving vector. I haven't done this literally in pretty much almost a year, because you guys recall I haven't bought a single individual stock pretty much throughout this entire year outside of a penny stock called Aduro Clean Technologies, but that's a more speculative based investment, which I think is going to do pretty well, but it only makes up like less than 1% of the entire portfolio. But again, guys, this is where we currently sit, and I love these comments that you guys offer. I think this was a very insightful video, and I'd love to know what you think in that comment section below.